I'm a second generation hotel guy. My dad, I was raised in hotels. My earliest memories are, being 5, 6 years old, chugging along with my dad when he's doing property walks at hotels and, looking for broken light bulbs and, all that kind of stuff. And so raised in hotels, the whole thing, counting money, putting in little sleeves, dropping it off in the bank, all that kind of stuff. Went to undergrad. Didn't study anything related to finance or anything like that. Did international languages. I speak Mandarin, Chinese, and Tongan, or Mandarin, Chinese, Arabic, Tongan, in addition to English. And then went to law school. Law school was really important for me. I went to Yale Law School. At Yale, I started a tech company called Invone, investor and owner, right, came together. And Invone's idea was that you could fractionalize residential real estate home equity, just like you could do for commercial real estate home equity. So it's kind of the Crowd Street Fundrise realty, but for residential, for homeowners. And so that was kind of my first foray into real estate, really deep real estate finance, and how it all worked. We were venture backed. We grew. We had investors. One of the board members of Goldman Sachs invested in us. We had some other folks that invested in us. We got really big. I ended up leaving that to found Wolfgramm Capital, actually. So I saw an opportunity in 2021-ish, end of 2020, early 2021. COVID's hitting, hotels are shutting down, or occupancy is dropping in half and or a fourth. And so I was thinking, hey, let's think about how we can take advantage of this. So Wolfgramm Capital was formed during the realization that there was a buying opportunity that is once in a generation for hotels, partly because of COVID, partly because of some of the other things that we're seeing with high inflation rates and a lot of cheap debt that was coming out and maturing. So Wolfgramm Capital, we formed it about 2 years ago, looking at what the pipeline would look like, projecting out what we thought hotels were going to be, that they were underpriced at the time, but that they would come back, and that we needed to form it now and buy now, rather than buying it in 5, 6 years and hotels have already all kind of stabilized out. That was how it was originally formed. It was formed by a combination of three of us who founded the company, a mix of legal, hotel operations, and finance. Hotels weren't necessarily being foreclosed on, but there was a ton of uncertainty in the market. I mean, this is back in, no vaccine, countries aren't open for travel, flights, one person per row kind of thing, like the whole thing. And so when hotels are getting hammered, I was long on hotels and bullish on a long-term outlook of hotels. I think would come back. And so got together with two of my co-founders. One is my father, who's been in hotels operations and all that for his entire career. My dad came from Tonga, which is like near Samoa, Fiji. And another is an attorney that I actually worked for, my uncle. And he had done a lot of the attorney side for the hotel companies. Anyway, and so we got into there and we were like, look, let's think about hotels. Let's think about how we can buy them at attractive bases. And particularly a hotel that maybe struggled during COVID, or what happened is 2018, 2019 was a banner year for hotels. So a lot of frankly, unexperienced, especially apartment folks, they did some basic math. They said, look, I'm making $1,000 a month in this apartment room. If I owned a hotel, I'm charging $100 a night. That's 30 nights. I'd make $3,000, $4,000 a night. Hotels are basically apartments with short-term leases. A bunch of people got into hotels 2017, 2018, 2019. Some even got in 2020, cheap debt. Turns out that hotels are some real estate, a lot of business, right? A lot of it is the business side. And if you don't understand the business side of the operations, hiring GMs, trainings, how sales works on the hotels, how to manage your rate, your occupancy, all those kind of things, a lot of people started losing their shirt. And COVID was, the water's coming out. People aren't reserving funds to fix things, all this whole kind of stuff. So we ended up coming in. We weren't planning on growing necessarily as fast as we did. We were looking at like one or two hotels off. Turned out our first acquisition was about a $40 million portfolio of hotels, about 500 rooms, mainly in Texas. Bought that, just started growing. People knew about us from different backgrounds that we had and different deals started flowing in. We bought a bunch of those limited service types of hotels, which is your Fairfield, your Courtyard, your Residence Inns. But our strategy was always to think about it as you have limited service hotels, which provide steady cash flow, high cash and cash returns, maybe less appreciation in the long term, though, right? You're not going to get a Residence Inn that's going to go from an $8 million hotel to a $50 million hotel. It's never going to happen in anyone's lifetime, right? So we have the limited service hotels. We like those, and those also are the ones that weathered COVID really well. So even though you know luxury resorts, Ritz Carltons were going from 70% occupancy to 0% occupancy, limited service hotels are going from 80% occupancy to 40% occupancy or 50% occupancy. And so they were still, even during COVID, a lot of them were still kind of turning along, maybe not turning a profit, but still going along. So we like the limited service side. And then we really like also ultra luxury and nothing really in between. So we weren't doing full service, we weren't doing convention center, we weren't doing big urban 400 room hotels. We were doing limited service. And then in August of last year, we bought the Waldorf Astoria in Park City. And that was a huge, huge acquisition for us as a company. I became the youngest Waldorf franchisee owner in the United States. And so that kicked off a whole bunch of later acquisitions. We then bought a couple other luxury hotels, we bought another limited service. And so that's how we've been able to kind of get the company where it's at. There's two types of avatars of hotel owners, and they're radically different. And I think I'm unique in that I fit somewhere in the middle of the two. And that is, you have the immigrant family. My father's an immigrant. You have an immigrant family who moves to the U.S., lived at a Motel 6 and managed it, and then eventually bought it on a seller finance from the owner. And now their family owned it and ran it, and all their cousins lived there and they lived there. And that was a lot of how I feel like my upbringing was being in hotels all the time. The first time I ever ate a steak was at my dad's Holiday Inn in Anaheim, California. First time I ever had one, we got it for free. And so you have those owner operators, and they are typically owners and operators because they grew up, from the time the kid was 8, he was sweeping floors, he was checking guests in, he was refilling the vending machine. And then they go from the Motel 6 to a Sonesta or a Quality Inn. And then, 5 years later, they buy their first Marriott, right? And that's like a big deal, big banner, thing. Buy the first Marriott, they buy the Fairfield, and then they start picking up a little bit of, maybe over 25, 30 years, they have, a dozen hotels, right? And that's their life, that's their family's legacy. That's definitely an avatar for hotel owners, and probably the most common avatar for hotel owners on the limited service side. Then you get luxury side. The Ritz-Carlton owners, the Hilton owners, the Waldorf, the Luxor, the LXR, the Conrads, all those kind of luxury, JW Marriott. Those are typically the Wall Street guys, right? They're either big funds that own them, or big institutions, or trusts, or all those kind of things. Or it's guys who work on Wall Street, investment banking. They leave, they go do a fund, and they own those kind of things. But super, super common. I mean, the dichotomy could not be wider when I go to these hotel conferences. I go to both these hotel conferences, right? I go to hotel conferences that we get invited to because we own the Waldorf, and all I see are a bunch of ex investment bankers, ex Goldman Sachs, ex that kind of thing. And then I go to hotel conferences because we own a Fairfield in a town that's 40,000 people in middle of nowhere, Texas, and we get all those other kind of guys who grew up in hotels. And I think that there's something interesting about bridging that gap. I think something interesting about people talk about companies having boots, which is like, I think about like limited service side, people, owner operators, and then you have the suits, right, who are the Wall Street, whatever. I think there's something about putting boots in suits, which is how I kind of see myself as. Where I grew up in this, very lower class, blue collar, all that kind of stuff. Went to Yale Law, understood all the kind of high tech finance, managed a little venture fund, did some other stuff. And so the way we operate is kind of unique in that we have this experience, but we're playing also in the luxury side. So even our luxury side, we can go to a Hilton, even though Waldorf manages Waldorf, right? Hilton manages all their Waldorf. We can go there and meet with the GMs, and I can talk to them about their sales processes, their hiring of the employees, how, like, all those kind of things that sometimes you don't necessarily get from these big fund managers, or these big fund guys who have never really spent significant time thinking about hotels as businesses and kind of just look at it as, something on the map, check it off, whatever, buy it, and then forget about it. Our guiding investment thesis, the core thesis is that you do within the hospitality industry, right? So we like hospitality for a couple of reasons. Maybe I'll first say why we like hospitality, because I think that guides the next question will be. We like hospitality because hospitality is high liquidity vis-a-vis other real estate investments. So, for example, you might have an apartment or something, and we've done some apartments. We built some apartments. We built some in Southern California and all that stuff. So we have a little bit of knowledge in apartments. In apartments, you can have value add. You do some renovations. You increase the cash flow. You lease it out. All that kind of stuff. Right? Great. Hotels we like because there's that business aspect, right? So because you have the real estate and you have the business aspect, you can go into a hotel. We did this in our Marriott in just South Dallas, kind of just in a normal, it wasn't some big resort. It's a Fairfield Marriott. And we took this revenue from $2 million, and we're now just on $3.2 million in our T12 in the course of about 16 months. The reason that is that you can do things to hotels that you can't do to other types of real estate investments. You take it, you go have sales, do blitzes, you think about how you do your group rates or L&R rates, your rates. You can do all these kind of things with the hotel. So first, we like hospitality because of liquidity, right? It's not uncommon to have 13, 14, 15% cash on cash returns. Our highest last year was 16.68% cash on cash return, and on a limited service hotel. But our thesis is that we want to play on the both sides of the spectrum in the hospitality world, and very little in between. That's that is that we like the cash flowing limited service hotels will provide regular distribution checks to investors, right? Every quarter you get your 2%, 2.5%, something like that. And then we like luxury, which has the big value added appreciation. I worked for a little bit of time for managing a fund that was backed by First Round Capital, the venture capital fund, based out of New York when I was in law school. And the VC model is that you invest in companies that are really young, blah blah, and then you make 50x your money, and you make nothing in between, right? You invest at day one, there's nothing for 15 years, and then you get a Facebook, and you get your $50,000 turned into 500 million or something like that, right? That's really nice, and you can do that in luxury, but you offset that risk by also investing and putting a portion of your portfolio in limited service. So we like to do those two things. So you have luxury, a Waldorf, a Tapestry by Hilton. You have these things where you can buy them for 30, 40, 50 million, maybe even buy it from 100, 115 million. You put things into it. You maybe do a brand change. You add more rooms. You build more amenities out. And it's very, very possible that you triple the value of that hotel in 5 years. Triple it, right? If you're leveraging on a 35, 40% basis, then you're talking about massive return, but there may not be a ton of cash flow in the interim, right? There may not be a ton of liquidity. And so our thesis has been to look at those two areas that there's hair on the deal, whether that's operational side, whether that's development side, whether there's some other kind of things going on, something tricky, and then we try to improve those, and we work on both sides of the spectrum. So our investors get steady cash flow, and you also get big appreciation plays. My partner, who's my father, right? It's been really nice to be able to co-found this company together. He's been working hotels through about 3 cycles. So he started in the 90s, and his company that he was working for, really got into hotels when the Japanese pulled out, when the Japanese stock market crashed out. Japan was pulling everything out in the 90s. His company was buying more hotels. The company he was working for, so he was managing them, doing those kind of things. Then we saw the 2001, right? That's more of a quick cycle, whereas big terrorist attack, right? 9/11 happens, people were scared to travel, stay at places. There were concerns that there's not just going to be there's also going to be, I think Disneyland had some threats, some other things. So you have kind of a quick cycle and something like that, where it's an event-based cycle. Then obviously you have 2008, 2009, right, with massive recession, and you have that long cycle. That's the one that probably more people are familiar with. Then you have the COVID cycle, which was kind of a mix between, there was some stuff going on with the it being a kind of an event-driven cycle, but also there were some underlying things, you saw inflation, interest rates, some other things happening in the macro aspect that was slightly related, but also there's kind of its own things going on with the inflation and some other things that are happening on the macro that weren't necessarily event-driven. And so the way we think about cycles is that depending on what cycle you are in, it's kind of like investing in the stock market, right? When you're investing in the stock market, it's not that stocks are bad at any given cycle. It's what the strategy is to buy the stock matters in a given cycle. So in a cycle where you're having booming, hospitality, 2018, 2019 was like this banner year, bunch of stuff is going on, fairly cheap debt at the time still. Hotels are doing best years ever, like all that kind of stuff's on record. People are traveling, all that kind of stuff. Like in those types of hotels, or in those types of deals, one, you're looking at divestiture, right? So when we have big years, you're looking at, or is it time to sell, refinance, take some chips off the table, you start to think about those things. But you're also at those times, you're looking at, you probably don't want to be building new things at the time, or you don't want to be building during the best years and opening in 2008, right? That's the worst thing to do. But in down cycles, those are the times you're thinking, okay, maybe we're taking on a project. Like maybe this is the year and that's what we've been doing, is say, hey, we're thinking about projects where, yeah, we're gonna add on a new wing to a project, right? We're gonna add another 50 rooms, another 60 rooms, we're gonna add another column and all that. And yeah, it might affect the operations of the existing hotel, but it's time to do that as a down cycle, right? Because the hotel is already down 30% in revenue off of its all-time high. Going in a low year and dropping that by another, maybe 10% from some disruption on construction, that's a lot better situation than doing that in the up year. So kind of depends on what strategy we're using. I'll say the other side is because we're very focused on operations. So we like to think of ourselves as vertically integrated, and we're pretty radical with that idea, in that we also own a property management company. We manage all of our own hotels, other than the ultra resorts. They're always managed by Hilton, Marriott, those guys. but we manage our own hotels. What that allows us to do is allows us to keep a really tight pulse on where we are in the cycle and also what's happening on the individual hotel. So it's important to be directionally correct in the macro, I think, but it really matters about execution of the micro. There are a lot of hotels that failed during COVID, and there were some hotels that did very well during COVID, right? They marketed to the nurses and the doctors that were traveling around, having to handle. They were marketing to the the response teams, the medical response teams, and they were doing those kind of things really well. You can only do that if you actually manage the hotel and you manage your customer base and you're actually involved in those sales process. You can't do that if you're just reliant on a third party company that's managing 5,000 other hotels, saying, "Hey, I hope my hotel gets some love this quarter." Within the company, right? We like to promote early and often. So we like to think that people can come in, learn quickly, and be given responsibility very, very quickly and be promoted, and then encourage them to think from a first principles basis to revolutionize the hotel industry. So the hotel industry, kind of like the financing industry, maybe about 10 years ago, was ripe for innovation. Right? There's very few things that have been even today. I'll say this: I love Marriott and all that. If you were to peer behind a front desk when someone's checking you in, you'll be appalled at what you see on the technology. I mean, it's why you'll hear them, right? People are checking in. What's your name? Wolfgramm first name, Koloa. Okay, you're checking in today. Yep. How long are you? 4 days. And there's 75 keystrokes happening for that. Like, how can that be? How can it take 75 keystrokes to check someone in, right? And you look at the screen and it looks like old DOS system, like old Apple, where it's like the big box that's blocking. There's no mouse, and you can't. It's just weird. That is true throughout the hospitality industry, right? From the way that people buy hotels, the way they finance hotels, the way they think about managing the hotels. And so one of the things we've asked all employees to do even is let's think about why we do everything that we do, and let's think about how do we do it better. So here's a simple one: is you have to vacuum hotels, right? They get vacuumed all the time. Each individual rooms gets vacuumed, and then every corridor gets vacuumed. It costs a lot to vacuum those hotels. It takes a lot of time away from housekeepers to go and do that, and it's also not exactly comfortable work to do, right? To vacuum hotels. So we bought. I had a friend, PhD at MIT, and all that kind of stuff, and bought some robots from him that vacuum hotels. Cost us like $20,000. They vacuum every room in every hotel. And we end up saving that money within the first 3 months. First 3 months, the cost that we would actually labor cost, and that's not even including workman's comp, all the other kind of stuff that associates with actually having someone back in hotels. People bending over and switching things out and all that kind of stuff. Did this robot do it? Like we're the only hotels that do that. Like, to this day, we're one of the few hotels, maybe a handful of hotels that use automated systems for vacuuming. Another one is in sales, right? You have people knocking on doors. Hey, next time you guys move in, or next time you guys, your company comes to, Houston, why don't you come stay at our hotel? And then you send a little gift box afterwards. Super, super slow. We hired this tech company that sends out 800 emails a day, cold calling and following up automatically and scheduling it and backs into our system. Like no one's doing that. One of our hotels, we've closed $500,000 of business the last 3 months doing that, right? So the one thing to think about is how do we revolutionize the way the hotels are run, bought, managed, and then sold, and in a way that takes both technology and also our own experience, having done all these things on the ground level, and pushing the industry forward. I remember the first time we bought a hotel, and I stood in front of our employees, and it was my employees now. Really the first time I had employees that weren't other co-founders or that kind of stuff, whatever. But these are these employees were the employees that my father was 20 years ago when he came to the United States. They were doing night audit, they were running front desk, they were maybe cleaning or security or whatever else. I remember the first time standing in front of those employees, and now they were my employees at this point. And I remember thinking, I really want this hotel to do well, good for our investors, but I really want the hotel to do well for. These are just people's livelihoods, right? I was one of these people's kids who ate because the hotel stayed open, right? Who got to get backpacked and got to get new shoes in a school year because the owner didn't do something stupid by running the hotel into the ground, right? Those kind of things I think about a lot. When we have hotels, I think, I don't want the hotel to go down, but I want these employees to be safe. I want them to be happy. I want them to also have upward progression, right? I think about that a lot. Have we created a way? Because my father was this way. Started out driving a shuttle bus, from Disneyland to the hotel he worked at. He was a shuttle bus driver, and then eventually managing very large hotels, and then working for the group that was buying the hotel, right? That was actually on the acquisition side. And I thought about this a lot in that, are we providing enough training opportunities where our housekeepers can then become the hotel, part hotel ownership with us, or the GMs, or the president of the management company, or something like that? We're providing that upward mobility? And the reason why that is important is that when our guests, right, they come in, they expect hospitality, right? They expect to be greeted, they expect to be looked in the eyes. How are you? Good morning, sir, ma'am, all that kind of stuff. And that comes from our employees. So if our employees aren't taken care of, they don't feel like they have upper mobility. They're excited about being at work. They think that there's something in it more for them other than taking home, $15 an hour in their paycheck. Then the customer is going to feel that, right? The guest is going to come in. They're going to feel that this hotel's dead. People are just moping around. They're just clocking in, clocking out. Those kind of things I think about a lot. And it directly relates to the performance of the hotel. The thing that gets me up in the morning is to prove out, and I think this model is not clearly proven out, that you can do both of these things. To show that you can not just be the owner operator, but owner operators can also play in the luxury side, right? There's kind of a clear split. Sometimes you go to these conferences, you see that, there's these guys, these are the Wall Street guys, the investment bankers, these are the owner operator kind of guys. And I like to think that we are uniquely situated. I also think that you don't necessarily need to be 80 years old to buy your first hotel. I'm fairly young. I bought my first hotel when I was in law school. By the time I graduated law school, I owned about 5 hotels at that time. And I think you can do that if you have the right team and if you have the right experiences that led up to it. I think you do have to have hotel experience, and then finance experience and lending experience and all other kind of stuff. But you can learn that. And so those are kind of things that interest me. I also think that hotels in specific, hotels are a place where people create memories, right? People, you're traveling, whether it's work, family. I have so many good memories being at hotels, right? So many of them, right? We travel, and because my dad worked in hotels, we get a little discount. We go to Disneyland, we go swim in the pool, we go watch a pay-per-view movie. We used to wait for the pay-per-view movies to come out. So we go watch it at the hotel for free, right? It's some empty, dirty room. We go in there, and in exchange for us making the bed, we can watch the pay-per-view movie that just came out, right? The new, Star Wars or whatever else. Like I have a lot of those memories. I love the fact that we are creating investment into places where families are coming, individuals are coming, they're creating these memories, whether that's for business, work, personal pleasure, leisure, all that kind of stuff. I love the fact that we provide those venues. It can be really easy when you're hiring to index on the things that you are good at and subscribe value to your own strengths, the person you're hiring. So we hire at some very high levels, right? We hire both in our internal firms, people making hundreds of thousands of dollars a year. We're also hiring all the way through down to like housekeepers, right? Who are hourly workers. It's very tempting to say, I'm good at X. This candidate is good at X. Therefore, I want to hire them for this job or placement, or whatever else. That is a extremely difficult thing to get over, and to work around, because sometimes the job doesn't require X, but also sometimes the guy may be good at X or Y or whatever else, but there's not the right, cultural fit. And so, hiring matters a lot. We have 250 some odd employees directly employed by us. And then we also have several other 100 employees that are, employed by Hilton, but have properties that we own. And, we have some interplay between how the hiring works. And so when I've interviewed hundreds of candidates across very various different jobs, and that's a lesson that we've gotten wrong sometimes, right? Where someone was good at something that I was good at, and so you think that candidate is going to be good at all these other things, and it's a personal bias. And you hire them, and it turns out maybe not a good fit, or that you let that bias take over. So that's been a lesson that we've been learning, and continuing to learn. We'll be growing our team a lot more, right, in the future. As we continue to buy hotels, we bought $350 million worth of hotels in the last 2 years alone, right? That's in our first 2 years, and I think we expect to see actually larger growth in the next 5 years. But nowadays, when I hire, I have a very set, clear criteria. I try to be more objective than anything else. So what I do is, for example, I was looking at, we were interviewing a very high level, very important executive position for one of our companies. Compensation somewhere between 150 200K type of range. Only very qualified candidates, that kind of thing. And so what I did was I thought about what are the skills that this person needs, right? Before I've ever looked at resumes or looked at anything, what are the skills that I knew this person needs? Both soft and hard skills, right? Some of these skills might be, financial modeling in some pieces. Some of this might be, interpersonal skills, leadership skills, team building. There's kind of a slew of skills. Ranked them out. And then I created a simple rubric, and it was 1 through 4, 1, 2, 3, 4. One being well below average, or well below average. Two, slightly below average. Three, slightly above average. Four, world class. Okay. So for each one of these skills or talents or whatever it was that I was looking for in this position, rank that out. Then when I interviewed each candidate, I would rank them on this rubric. And so so for some people it would be, okay, yeah, maybe leadership skills is 2, but their financial savviness is 4, whatever it was. Put it all out. And what I'm looking for there is it's an objective read across all the different skills. And it also forces me, by not having that middle kind of little number of average, it forces me to say, is someone below average or above average at any given skill? I can't just, because everything ended up reverting to the mean. I used to do it 1, 2, 3, 4, 5, and ended up a ton of 3s. And it's like, you know what? I'm not asking the right question then, because as I'm asking the question in the interview, I'm thinking, it's usually clear if they're a 1 or a 4, right? Someone's world class comes across real fast. Not always obvious if they're a 2 or a 3. It's not always obvious if they're below average or above average. You got to ask a couple more questions to get that. And I'm thinking in my mind, hey, when I finish this interview, I'm going to go back to that sheet, and I'm going to be staring at the 2, and I'm going to be staring at the 3, and I'm going to think, which person is this in? So I need to ask the question to really understand that. Then at the end of the day, I look at it, and what I'm really looking for, though, is I'm not looking for 3s. I'm not necessarily looking for a bunch of 3s down the road. I'm looking for a ton of 4s, is what I'm looking for, or the 4s that really matter. I want world class. I don't want average. And that's one way that I've been trying to move away from any personal biases that creep in during interviews and be a little bit more objective. When it comes to our investors, we care a lot about our investors having the same conviction in every investment that we make, that we have. So transparency, both transparency, but also detailed and rigorous analysis that's presented to investors in a way that they can digest and understand is really, 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 really important to us. The worst case scenario, and this is intentional, none of us come from sales backgrounds. None of us come from really the hard sell, I gotta, get the investor at any given, whatever, and just get them away from their money, and then we're happy after that. We really care about investors understanding the deal, having transparency to the risk factors and how we're mitigating those risk factors, make sure the incentives are in line. So I think there are a couple of things in the values. One is transparency, right? Being open with the things that we're seeing on the deal side, and how we see the deal and how we're looking at it, risk factors. 2 is having radically aligned incentives. So that's the other thing that I think is unique to us. Typically, in every deal, we are the largest investor, ourselves, the GP. Typically, we are the single largest investor in any one of our deals. I think that provides a lot of comfort to investors in that if something goes sideways, we're right there with you. In fact, we're probably taking the biggest loss of anyone else that's investing with us. A lot of times we're at 20, 30%. Some deals we're at 80% of the capital stack, right? If things go bad, we have extreme incentives to make sure the deal goes well. Outside of any GP, LP, whatever out there, for our own capital that we're putting into the deal. So I think that matters a lot for both transparency and then alignment of incentives. And then I think the third thing that we value a lot is creativity. So creativity, which I think leads to innovation and some other things, but being able to be thoughtful and creative in the way that we think about how we do our job, how we do things to investors, how we report to investors, how we run the hotels, how we think about financing the acquisitions, all those kind of things, I think roll up under this creative umbrella. And so I think I'll say those are the 3 things that we value a lot at the hotel or at the company: transparency to investors, alignment of incentives, and then creativity and innovation. So I went to Yale Law School, and as part of that, we like deals that are hairy, right? The Waldorf was like that in Park City. We like deals that have nuance to it, where maybe there's clouded title, maybe there's some litigation pending, maybe there's operational deficiencies that are not clear to an average person who comes in and just hires a third party and lets it run. And there's maybe we bought hotels where the GM was defrauding the company, right, and stealing money from the owner, and we had to buy it and work that out and make sure that there was security escorting people off. We love those kind of deals because usually there's increased upside on that. And so I have a law degree. My 2 other co-founders both have law degrees. Only one of us has practiced for 30 years, but I think having the law degree allows us to think about risk in a way that makes sense for our investors, and allows us to identify risk, qualify that risk, think about what are the different types of risk, how likely are these risks to turn into anything, and then how do we mitigate those risks? That's where the kind of the business side comes in. So I think we do a good job at that, and that's something that makes us a little bit unique in the broader hospitality market. Our financing has typically been for a hotel that's open, operating, cash flowing, but we see some operational deficiencies, things like that. Those are pretty easy to finance. We've used debt funds, we've used big banks, we've used local banks. Local banks currently are typically a lot better. And so we'll go, 65-35. If there's maybe a PIP, it's the property improvement plan. Sometimes when you buy a hotel, you need to, there's a renovation that needs to be done to it. That's how the brand kind of makes sure that their hotels are being updated regularly. You don't have, carpet from the 80s still in a hotel. And that when you buy it, they say, hey, you're going to buy this new hotel. I'll give you a year or 2 years, and you got to replace all the carpet, all the beds, all the drapes, all the furniture, that kind of stuff. And if you do something like that, the leverage might be a little bit higher because the acquisition loan will take into account that additional loan. So maybe go up to 70% or something like that. We've also bought some things all cash. We bought the Waldorf Astoria all cash. So that was an all cash closing. That had to do with, there are some things that had to be cleared up with some other things. We signed the PSA on August 3rd, and we closed all cash August 5th. We closed 2 days later after signing PSA, and that was unique. But other than that, the financing is somewhere between 65-70%, and that will, you do it on we have some that are a little bit longer term. If maybe there's not a huge big improvements that we're making that's going to then realize a refinance, it might be a 10-year hold or something like that, and the hotel is basically turning along, and maybe the refresh, the renovation isn't due for another 5 years. You save up during those 5 years for it, and then you do it. You continue on. Some of our hotels are on like a 3-year bridge loan. We some of those loans have floating rates, but whenever we have a floating rate, we always buy an interest rate cap to fix the loan. So we'll either buy it at the outset and make it a synthetic fixed rate, or we'll buy it, at a strike cap that hasn't yet hit. So once the base rate hits that cap, then now you're fixed. So your worst case scenario downside for the interest rate.